Hey guys, I'm Chris Gorman, and welcome to another edition of Real Estate and Money. It's been a crazy week. We witnessed and are witnessing one of the craziest banking failures in United States history. So we'll recap the last week of events and talk about where we're at now. I'm going to highlight today one upcoming opportunity in the world of real estate investment that I think you need to be keeping a lookout for. And then finally, a little bit of speculation on March 22nd Fed meeting that's coming up this week and what they might do or not do with interest rates. So, first, to recap, if you didn't see the last video, and if you don't mind, if you're watching this on YouTube or Rumble or another platform that you can subscribe to, please do hit that button. It helps me out a lot. So, last week and the weekend before, we witnessed the failure of Silicon Valley Bank and Signature Bank, um, and are now witnessing a potential failure with First Republic Bank and several other regional banks, of which there's, I think I heard 99 different regional banks that are being affected right now. And so, what happened? Basically, in a nutshell, I'll give you the 60-second version. Um, Post COVID economy, a lot of companies very flush with cash and they need a place to put that. So they put it in the bank. And the bank can't just sit on all those deposits. It's good banking practice to take in money and then lend out a commensurate amount of money while keeping enough reserves on hand in case the depositors want their money back. But that's bank management 101. They have to do that. And so, uh, in hindsight, maybe the bank made not such a great decision, but at the time, I'm sure was seen as a very risk averse decision to invest in 10-year treasuries. Um, when the rates started going up, that presented other investment opportunities for companies and investors. So they started to take the cash out of the bank and put it in these, for instance, 5% on a 90-day treasury note you could have got last week. So it doesn't make sense to keep so much money in the bank paying zero interest when you could store it over here and make 5%. And uh, enough of that happens, and then all of a sudden you have a very fragile situation where the bank doesn't have enough cash on hand to provide all the depositors with their money back when they try to withdraw it, and it creates what they call a liquidity crisis or liquidity issue. So what did they have to do? Well, they had to access all those bonds that they bought, except because of the raising rates, or the higher rates, I should say, the value of those bonds that they bought went down. So they actually had to take a loss to the tune of about $1.2 billion, which further exacerbated the liquidity issue and created a downward spiral. And the Fed had to step in um, and halt trading on the bank and basically take possession of it. Over that following weekend, bank and or the Fed came out and said we're going to backstop all the depositors, which seemed to calm the markets down for a moment. But the issue didn't just stop there. This is being seen at financial institutions across the country. And it raises the question, are all bank accounts insured over that $250,000 FDIC limit? Because it would seem to imply that they are. But the Fed can't come out and just broad brush say that, because that's a policy change that has to happen in Congress. What they can do is evaluate banks on a case by case basis, which they have been doing. And thus far, they've pretty much said they're not prepared today to let these institutions fail. So that's where we're at. Over the last weekend, we saw a 170-year-old institution, Credit Suisse, fail and have to be absorbed by UBS. And so that was really interesting. This is, we're talking about institutions that are older than anybody that's alive right now, failing in a weekend. So pretty crazy stuff. Something to just keep an eye on as we go out the next couple of weeks. But what impact long term is all this going to have on us and on investors and on the real estate markets? Hard to know for sure, but one thing is for sure, that on the other side of this, we're very, very likely to see a tightening of regulations akin to what we saw after the recession in 2008. So if you remember that time during the mortgage crisis, banks got really tight on their lending. It was really tough to get money. And then, as things do over time, they kind of loosened the guidelines and it was easier and easier. And then they came out with more creative funding products and kind of, although we're not in the same situation at all that we were back then in terms of, the mortgage-backed securities and the garbage loans that were written. We're not in that situation, but there are other situations at play. One of which is adjustable rate financing. So it brings me to my second point. If you haven't heard of a real estate syndication, what that is a group of investors all contributing a relatively small individual contribution to a much larger fund with the intent to buy some income producing asset. Usually, apartment buildings is what a real estate syndication will invest in primarily. Um, so let's say you wanted to get into real estate investing, but you're not really sure that you want to go it alone and you maybe don't have the resources to buy something outright by yourself. Well, for a relatively small investment, you can get into a syndication with a whole bunch of other people that are investing in this one asset that is run by some syndicator, some guy at the top that hopefully knows what he's doing, he or she is doing, running this fund. And you get to participate just like you owned a share in a stock. You now own a share of this real estate, or proportionate ownership to whatever investment you made. But you get to participate in the cash flow. You get to participate in the ability to depreciate your portion of that asset on your taxes. So it's a really, really cool strategy to get into the real estate investing world. It's become extremely popular over the course of the last 10 years, especially with debt being as cheap as it has been. But a lot of these syndicators got into projects where, in order to make the numbers work, they had to take variable rate debt. So if you're not familiar with an adjustable rate mortgage, oftentimes the adjustable rate mortgages are lower rate than a fixed rate. So let me say that again. The adjustable rate mortgage today, you can get an adjustable rate mortgage for cheaper or a lower rate than you can a 30-year fixed rate mortgage. The upside to a 30-year fixed rate is that you know what the rate is. It's going to be what it is today over the next 30 years. So while an adjustable rate loan may be cheaper, it does have some inherent risk because if rates go up, so does your mortgage. Well, the debt that a lot of these syndicators got is kind of the same. And now that rates went up, they're being faced with a cash crunch because they can't raise the rent on their tenants to offset what they have, what their new loan payments are, because the market just doesn't support that yet. So now you're going to have, over the course of the next 2 or 3 years, probably a decent amount of these projects failing and becoming distressed. And while I would never root for that. I never would want to see anybody or any even institution lose. It's just not fun. But that's the world we live in. And so you have to, as a savvy investor, pay attention to these things. And you have to have cash on hand, uh, investable money that you can just be ready to pounce when opportunities present themselves. So if you're not in real estate investing and you're thinking about getting in, this might be something you want to keep an eye on over the course of the next 12 to 24 months as things continue to unfold. Um, as an aside, I am hosting a real estate investor seminar, and it is kind of a 101 type class coming up in April. I should know this off the top of my head. April 19th at 6 p.m. It's a Wednesday, and I've limited it to 10 spots, and we already have a handful of people signed up. So I don't have a whole lot of room left. But if you're interested in learning more about real estate investing, not only talking about syndications, but short and long-term rentals, fix and flips, we're going to be going through kind of all of that from the ground up. And I'm a real strong believer in real estate investing. All this stuff that's going on right now, um, is just proof in the pudding for why real estate is such a good investment. You know, a lot of things like your stocks, if you owned any of these bank stocks, don't look at them because you know they're way down from where they were just a couple of weeks ago. Real estate's just not that volatile. It's always going to have some intrinsic value, and you know, if the world goes to hell overnight, people will always need a place to live. So I love real estate as an investment. It's not that I'm, you know, here trying to sell you something. I that's how I invest. I'm a real strong believer in the strength of real estate as a vehicle to build long-term wealth, and I love teaching other people about it to the extent that I can. So, if you're interested in that, attending that seminar, please reach out to me and I can get you signed up. The last thing I want to mention, so the Fed is meeting again on the 22nd, which is Wednesday. It is Wednesday, right? Yeah, Wednesday this week. And they're meeting to discuss what to do next with rates. So they've been raising rates for a while now, trying to bring inflation down. And oftentimes when you see something like we've been seeing over the last couple of weeks, where you have an institution or a sector of the market that fails, that's oftentimes a signal for the Fed that, okay, it's time to calm down, maybe reverse course. And so there's a lot of speculation. Will the Fed continue with their planned rate increases, or will they maybe reverse course and reduce rates, or will they just do nothing? There's serious financial institutions that you can find that contradict each other on this point. Nobody knows for sure, and it's probably going to be a game time decision to see what happens over the next couple of days in the banking world. What we want, or what I want, is long term stability. And I fear that if they reverse course now, they haven't yet achieved their desired result, which is to bring inflation back down to around 2%. They're a long ways off from that. So definitely don't want to see them reverse course prematurely and then have to overcorrect even to a larger extent later. Probably would be okay if they just did nothing this quarter and reevaluated next quarter. But they're likely to probably continue with their increases despite what's going on in the banking sector. And most people are saying 25 basis point increase or 1/4% to the federal funds rate. So we'll see what happens and what effect that has on all of us in the markets going forward. But keep an eye out, and if you're interested in learning more about the syndication, there's tons of articles out there you can find to get educated on syndications. And of course, like I said, if you're interested in attending the investor seminar on, I already forgot the date, the 19th, please reach out to me. So that's all for now, and stay tuned next week for a new update. Have a great day.